Welcome to this week's episode of Jonathan on Money. This is episode number 134. So, this podcast is dropping right after I come back from a short tropical vacation. While I can't give you a full recap on my trip on this episode, what I will say is this important point. Money is a tool, it is not a scorecard. There's no prize for being the richest person in the graveyard, and leaving too much money to your kids will likely cause more harm than good. This is a long way of saying to enjoy and spend your money today because money is a tool to enhance your life. Furthermore, no one knows what the future holds. You may not be able to do cool things with your money in the future. So, again, enjoy today. Before jumping to this week's episode, I'd like to share that my upcoming fall live webinars will continue on Thursday, November 13th at 8:30 a.m., featuring Avi Z. Kestenbaum, partner at the law firm Meltzer Lippy based in Long Island, New York. And Avi's going to be speaking on business and real estate succession planning, and I'll be sure to include the registration information in the show notes to this week's episode. Okay, now for today's agenda. My talking points this week will discuss three mistakes investors make when interest rates fall and how to avoid them. Our quote this week is from Eugene Fama, comparing soap to investing. I'll spend the last half of the episode answering listeners' questions, including my thoughts on Tony Robbins' book called The Holy Grail of Investing. And finally, we'll end with an actionable idea to implement your investing life, where we're going to discuss how to have an impact with your portfolio by expressing your values through stock ownership. And with that, let's jump into this week's talking points. So, investors once again find themselves in this of a rate lowering cycle. The Federal Reserve lowered federal funds rates twice this year, and the rate is currently in the range of 3.75% to 4%. For those who don't know, the federal funds rate is the lending rate that banks use when they borrow from one another. Its impacts are far-reaching, however, affecting credit card rates, mortgages, car loans, savings accounts yields, the borrowing costs, business pay, and more. In many ways, lower rates is a positive for consumers. But investors may not see it quite as positively. In order to compensate for lower yields on investments, many investors are tempted by options that promise higher yields and, as a byproduct, create far more risk within their portfolios. During every falling interest rate environment, I've noticed investors making the same mistakes. If advisors anticipate these common mistakes and identify how to properly address them, they'll be well equipped to help guide their clients through this part of the cycle and keep them on track financially. Okay, I'm going to list the three most common mistakes in this interest rate environment. First, reaching for yield. Over the past few years, investors have enjoyed putting their cash in money market funds and collecting attractive yields with virtually no risk. However, as rates come down, these risk-free rates will also fall. While searching for higher yielding investments, investors may subject this money to volatility and possibly the loss of principal. Focusing on the yield of an investment at the expense of all other due diligence will have an unfortunate ripple effect on the rest of one's finances. Money that folks need for near-term expenses or a rainy day fund should still sit in cash or cash equivalents despite a more modest yield. The second point is pursuing lower credit quality. Investors may be enticed by lower quality credit to maintain a certain yield within their fixed income allocation. Unfortunately, that means investing in companies which shake your balance sheets. This may be fine for a small portion of one's portfolio. However, substituting most of your fixed income to obtain a higher yield is ill advised. As I frequently remind my clients, risk and return are inextricably linked. If you want higher yields in a low rate interest rate environment, you need to be willing to take more risk with your capital. It's important to keep in mind that the ultimate role of high quality bonds in one's portfolio is to serve as a ballast against more volatile equity positions. Once you invest in lower quality companies, those diversification benefits and the margin of safety is gone. And finally, number three is extending duration. Another way for investors to maintain targeted yield within their portfolios by extending the duration on their fixed income holdings. In other words, instead of going out 1 to 2 years on the yield curve, they instead go out 2 decades or longer. The challenge is that duration is a measure of a bond's price sensitivity to interest rate changes expressed in years. Therefore, a bond with a higher duration is more sensitive to interest rate fluctuations. Its price will change more significantly for a given change in interest rates than the price of a lower duration bond. For example, a bond with a 10-year duration expected to lose approximately 10% of its value if interest rates rise by 1%, whereas a short duration bond would be expected to lose only 1% of its value. Granted, we are in a falling rate environment, but any unexpected change in interest rate policy can leave bond investments just as volatile as equities. Extending duration on your bond leaves you to more portfolio volatility without the upside that equities provide. To conclude, in order to avoid these common missteps in a falling rate environment, I encourage my clients to take a step back and look at the bigger picture. Instead of focusing on the Fed or increasing portfolio yield, advisors should urge clients to focus on the factors that should actually determine their portfolio allocation. This includes their time horizon, risk tolerance, and goals. For example, if a client needs the funds within a few years, then using a savings account, money market funds, or short term CDs will always make sense regardless of the drop in yields. Investors should not risk money they need for new near-term expenses to get a higher yield. If a client is a nervous Nelly, then taking more risk with their bond quality, subjecting them to a higher default risk or extending duration and exposing them to more extreme volatility can lead to more panic when the markets are turbulent. Panicking typically leads to more rash investment decisions and liquidating their investments at the worst possible time. Finally, it's always worth reminding folks to stay focused on their goals. Neither the Fed nor movements in interest rates will be the key driver in your ability to achieve your objectives. Whether someone wants to retire in 5 years, save for college, or leave a legacy to their favorite charities, the ultimate determinant of success is having a plan and sticking to it through all market cycles. Developing a roadmap and a level of discipline are far more important than any tactical moves related to interest rates. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Eugene Fama. For those who don't know, Eugene Fama is an American economist known as the father of modern finance. He developed the efficient market hypothesis, revolutionizing investment theory. He's a Nobel laureate, winning the prize in 2013 for his research that shaped asset pricing, portfolio management, and financial economics, influencing academics, investors, and policymakers worldwide. Fama once said, "Your money is like a bar of soap. The more you handle it, the less you'll have." This quote points to one of the biggest mistakes investors make with their money, which is patchking around with it too much. Patschke is a Yiddish word meaning to inexpertly tinker with something, usually making that thing worse than it was before. The urge to buy, sell, move into something different, try to time the market, shop around for better investments, etc., are all good ways to lose money. Like soap, the more you mess around with it, the less of it you'll have. To put a Yiddish spin on Fama's quote, make sure to stop patchkening with your money. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question. Are you afraid about the deflationary damage caused by AI over the next decade? Afraid? No way. But first, for those who are not in the know, deflation is a decline in prices across the economy. While lower prices might sound good, deflation can actually signal economic trouble. When prices drop, people may delay purchasing, expecting even lower costs in the future. This reduced spending can lead to lower business revenues, job losses, and a slowdown in the economic activity. The way AI drives deflation is by automating tasks, reducing labor, and increasing efficiency. As businesses adopt AI, production costs drop, leading to lower prices. AI also enhances productivity, reducing demand for human workers in some sectors. This technological shift can suppress wage growth and consumer spending, reinforcing a deflationary trend. The reason I'm not concerned about this is because I view AI as just another technological innovation. People are adaptable and will figure out a way to harness the power of AI, just like new technologies of the past, to make themselves more productive and offer more value. People that don't adapt will need to get lower paying jobs or will be pushed out of the workforce. However, I believe as a society will embrace AI and continue the economic growth and stability. Personally, I know AI has helped me a tremendous amount in my own business. Okay, the next question is I saw online that I should use a Roth IRA instead of an emergency fund for tax reasons. Does this make sense? No, it makes no sense. I'm assuming you saw this hack from a social media influencer who posted this idiocy in between his dancing videos in order to get more engagement. Technically, you can pull contributions out of a Roth IRA without paying taxes or penalties on these funds. However, the whole purpose of Roth IRA and where its value really lies is letting your funds grow for decades without a tax drag and then pulling the funds out in retirement tax free. Using cash to pay for an emergency expense that comes up will inhibit your ability to compound those funds as quickly and may impact your retirement plans. It's far more sensible to not get fancy and keep 3 to 6 months worth of expense money in cash or a money market account. This will minimize this need to liquidate more long term accounts like a Roth IRA that are earmarked for longer term goals. Next question. Succinctly, what is the value of using a financial advisor? I make a nice living now, and my brother in law said I should open an account online and invest myself. I'm not convinced of his position, and I'm not convinced to hire someone. Thanks for your thoughts. I feel like I've addressed this before, but this question is asking me to boil down the benefits succinctly, so I will list just two reasons why it makes sense to hire a financial advisor. One, to keep you on track. Making the right decisions about money on an ongoing basis is one of the key to financial success. I can't tell you how many super smart and financially successful people make horrific decisions about money. They invest in restaurants, Nicaraguan timber, literally, SPACs, concentrate most of their investments in just one area, and give money to people they hardly know to invest in real estate in a part of the country they've never heard of. Every year, I am astonished at the silly decisions people make. An advisor can save you from these bad decisions and also help you make good ones on a regular basis. Reminders to stick with timeless principles, invest in sensible investments, add money on a regular basis, and so forth. Also, different complex scenarios come up that are not discussed as often. These may include inheritance based on beneficiary needs, coordinating multiple asset and income sources in retirement, juggling current goals with future legacy goals, mitigating various types of risks, disparities in spousal income, and how to plan appropriately, and so forth. Avoiding big mistakes and receiving nudges to make good decisions and approaching various financial and life decisions the right way is essential to all investors. You don't get those benefits by investing by yourself. And the second reason is you don't know what you don't know. Most people that are not practitioners in wealth management lack the scope of knowledge to make the best financial decisions. The financial nerds that are listening to this may think they have it all under control, but the truth is you'll never have the same level of knowledge as someone who has been a practitioner in the field for 20 years. There are many components to wealth management, and understanding how they work together is essential. For example, you may be super passionate about investing, but you need to understand how that works in conjunction with your retirement planning, taxes, insurance, estate planning, family dynamics, your goals, and investor psychology. Also, things change over time. The investment landscape has changed a great deal since I started in the industry. There are different investment options, rule changes, tax laws are overhauled, the economic environment moves in cycles, and much more. You may think you have everything figured out because you bought a cheap ETF on Robinhood that a blogger or podcaster mentioned. Unfortunately, you haven't even scratched the surface on what you need to know and what you should be doing. Working with an advisor can help everyone, even your know it all brother in law. Their next question is, do you think the classic 60-40 portfolio is dead? This is another question that has come up before, but resurfaces every year in the financial media, usually under the headline, the 60-40 portfolio is dead. What investors should do now. For those who don't know, the 60-40 portfolio refers to a moderate risk portfolio with 60% in stocks and 40% in bonds. Usually, when financial writers bring up the 60-40 portfolio, they'll say that it needs to be revised to include expensive alternative investments, which is not true. Having 60% of one's investments in stocks and 40% of bonds is a fine strategy. It may not be the greatest approach for certain types of investors, depending on their specific circumstances, but it is a sensible approach and always will be. It's diversified and has exposure to growth assets and stocks as well as bonds to balance risk. In 100 years from now, financial writers will still be discussing the strategy because it will continue to be relevant in the future. So next, and the final question this week is, what are your thoughts on Tony Robbins' book, The Holy Grail of Investing? He seems to make some compelling points. So I like Tony Robbins. I like his message of empowerment. I like his level of ruach. I like his rags to riches story. I like his hard work. Did I throw out enough compliments before I tear him apart? What the hey, I'll throw out a few more. I like the fact that he's 6'7". I like the way he changed his name from Anthony J. Mahavarich, and I love his firewalking shtick, although I would never do it. In terms of the book you referenced, he should be ashamed of himself. It may be one of the worst investing books I've ever read. Everything you read in that book, you should do the opposite. Its focus is about getting into boutique alternative asset classes, which makes sense to only 0.001% of the population. And by the way, his co-author conveniently runs a company who can get you into all those hot deals. Unless you have a few $100 million and don't mind blowing some of it up, then don't even consider any of these strategies. Frankly, I miss the old infomercial Tony Robbins, the Awaken the Giant Within Tony Robbins, the Unlimited Power Tony Robbins. Personal finance Tony Robbins is an absolute shanda. Okay, that's it for talking points for the financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to my team, and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actual idea that listeners can implement to their financial lives. And today's timely idea is going to continue and really conclude on the theme we've been discussing and focusing on, which is how investors can have an impact with their money. One other way to do that is by voicing disapproval through stock ownership. So the default approach for many investors is to exclude companies with business practices which they disagree. However, there are people who believe that the best way to affect change is by having a voice in those companies through ownership. Buying shares of those stocks allow an investor to vote on various matters, like the board of directors, and attend shareholder meetings. If the shares are owned through a mutual fund where one's voting rights are delegated to the fund managers, an investor can still call the fund's investor relations department to express his or her views on the position they want to take in the fund. Ultimately, for me, the goal with impact, sustainable, ESG, and values-based investing, or however you'd like to refer to it, is to increase the likelihood that investor will stick with their investment strategy because they're investing according to their beliefs. Staying the course during market gyrations and letting compounding work its magic is the ultimate way to build wealth and achieve an investor's financial objectives. And if ESG investing or a values-based approach does nothing else but encourages investors to stick with their portfolio over the long run and through down markets, then I believe it is a very worthwhile strategy. With that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.